Welcome to this week's question and answer video series brought to you by the Weekly Advertiser and Meritum Financial Groups, where you have the opportunity to have your financial related questions answered. My name is Ashley Rowan and I'm a financial advisor with the Meritum Financial Group. Today's question looks at end of financial year planning. So here's the question. With the end of the financial year fast approaching, are there some superannuation or investment strategies I can consider to improve my position? Thank you very much for your question. Yep, now is a good time to check that you have made the most of the opportunities available to you this financial year. It is also a good time to review your super strategies and put your plans in early to set yourself up for next year and ensure you get the most out of the tax-effective super environment. Superannuation can offer many benefits, including earning up to 50% return on your investment, even in these uncertain times, by taking advantage of the government's co-contributions. You can also benefit by every cent you salary sacrifice to superannuation is taxed at a rate of only 15%, helping you keep up to 31.5% of your hard-earned money. Also, at age 60, any money you take out of super is completely tax-free, while you'll still pay tax on investments outside of super. So it's important to maximise your money in super while you're still working and under age 65. Now, it is important to note that superannuation is merely a concessional taxation structure which gives investors significant incentives to invest for their retirement. Simply put, each dollar you put into your super fund can provide you with significant tax advantages. Contributing to super from money you'd normally receive as salary means you'll pay just 15% tax on your contributions instead of paying tax at your marginal tax rate. So a salary sacrifice super contribution can reduce your overall tax rate, and it may even bring it down to a lower tax bracket. But be careful, there is a $25,000 per annum cap on the amount of pre-tax super contributions you can make this year. If you contribute above your limit, the tax penalties can be quite harsh. By adding to your super, you'll be making the most of super's tax benefits while ensuring you stay on track for a more comfortable retirement. How much you earn and how much you contribute to super each year will also determine what government co-contribution you are entitled to. If you earn $31,920 or less and personally contribute $1,000 in after-tax contributions to your super during the year, the government will provide a co-contribution of up to $500. Now, it works on a sliding scale of earnings, and I will display a table indicating these rates at the end of the presentation. To qualify for the government co-contribution, you need to receive 10% or more of your total income from employment, carrying on a business, or a combination of these both. You have total income from all sources of less than $46,920 in the 2012-13 financial year. You must lodge an income tax return for the relevant financial year, be less than 71 years old at the end of the income year, and make personal after-tax contributions to a complying super fund. Now, please remember that this is general information only, and if you need personal advice, you need to speak with a suitably qualified financial advisor that takes into account your specific details for giving advice. Thank you for sending in the question, and thank you for taking the time to listen. If you have your own questions that you would like answered, please go to our website and submit your questions there. We don't use any names when answering the questions to protect your personal details. Thanks again for watching the video, and see you next week.